I'm Komal and welcome to HP Wealth Insights, an initiative to simplify investing by HP Private Wealth Advisory. Are you thinking of investing in equity funds? Equity funds help build long-term wealth and they have consistently outperformed popular FDs and other guaranteed return products. Let's have a close look at FDs versus equity funds. Over the last 5 years, FDs have delivered between 5.5 to 6.5%, while equity mutual funds delivered a solid 12 to 15% per annum. Over 10 years, FDs delivered between 6.5 to 7% per annum, but equities rewarded patient investors with 13 to 16% per annum. Again, a clear edge to equities. Now let's go back to 15 to 20 years, and FDs ranged between 7 to 8.5%, while equity mutual funds compounded at 14 to 18%, comfortably outpacing inflation. For those who have stayed invested for 25 to 30 years, FDs averaged 8 to 9.5%, but equity funds delivered 15 to 19% per annum. Thanks to India's economic growth and market maturity. Now, here is where it gets even more compelling. Over 35 to 50 years, FD returns may have reached 9 to 11.5%, which sounds attractive, but equity funds beat that again with an estimated 16 to 21% compounded annual growth rate. So, should you invest in equity mutual funds? To decide, ask yourself, was there an FD that you kept rolling over year after year, 5, 10, 15, 20 years? And if you did, you have already missed half the return. Now ask yourself if you could allocate some portion of that term deposit rolled over money into equity funds. Sometimes the best return comes from a balanced approach. But now that you know the power of equity, the ability to beat inflation, the compounding ability, and the long-term growth that it can provide, how would you change your future investments? So let's recap on why you should invest in an equity fund. You should invest in equity funds to participate in growth and the long-term wealth building that it comes with. Long-term wealth is built by either owning a business or investing in a business. And to achieve this growth, equity isn't optional, it's essential. And if you need access to money in the first 5 years of its investment, volatility is something which does not give you peace of mind, and you're okay with receiving guaranteed returns despite the fact you know that you are not growing your money beyond inflation, then equity may not be right for you. Interesting, right? Why not connect with a SEBI registered investment advisor who can coach you and guide you into such dilemmas and help you make informed decisions?